Hello all and welcome to today's webinar. My name's James Gerrish. I am the lead portfolio manager at Market Matters. I'm also a senior portfolio manager at Shaw and Partners. Today we're going to keep it very simple and going to provide ideas around stocks we like here and now. We'll cover three themes from a bigger picture standpoint that we are investing towards, some rationale or reasoning around that, and then we'll dig into stock picks, which is why the majority are here, no doubt. So thanks again to all our wonderful members who have joined us today. We've got a growing band of members at Market Matters who enjoy and get benefit out of our service. And to those who may not be members and are joining the webinar, please consider some of the offers that will be going through your inbox coming up to the end of the financial year. There's a lot of savings to be made. I'm joined today by Shawn Hickman. Jump off mute and off your video, Shawn, if you can.
Hi, James. Nice to be here.
Just to give a quick background, if you don't already know Shawn and I, so I'm the lead portfolio manager. Shawn heads up the research function at Market Matters. Shawn's got a key tilt towards the macro environment. I've got more of a focus on the stock picking side. I've got 20 years experience. Shawn's got 30 plus years experience in markets. So we're operating in the markets on a daily basis, writing about what we see, and trying to pass on some of that experience and expertise that we've gathered over the many years in markets. Shawn, you slightly more than me, mate.
You wouldn't be able to tell, would you?
I'm younger than I look. Okay. First up, just a quick reminder that the advice provided today is of a general nature only, so you should consult a financial professional before taking any information on board. General information only. Just a quick slide on the screen there, just around portfolio performance as up to May. We actually run 5 portfolios through Market Matters website. We've got 4 on the screen there. The 5th one is a core ETF portfolio that was launched about a year ago. Active growth portfolio over the last year is up 18%, about 5% ahead of market. The income portfolio has had a bit of a struggle the last year. It's up 7.3. In a strong market. We've probably been a little bit too cautious in that portfolio, I'd say. The international equities portfolio is up 24% over the past 12 months, and the emerging companies portfolio is up 18.5% over the last 12 months. So we've had a reasonable period in terms of portfolio performance, and I think one of the reasons for that is the way we approach the market, and that speaks to our investment process. So we describe ourselves as top-down meets bottom-up investors. So top-down means we really think about and spend a lot of time thinking about the bigger picture environment, the macro backdrop, things ranging from global growth all the way down into interest rates, inflation, how markets are positioned in specific areas towards commodities and the like. So we think about the big picture first of all, then we develop some focus on the sector perspective. So we design a portfolio where we want to allocate money from a sector point of view, then dig into where the rubber hits the road, which is stock selection, and we have a range of quantitative screening and fundamental analysis. So that gives you a quick picture for how we approach markets, and it's an approach that's probably a little bit different to a lot in the market. A lot in the market suggests that you've just got to focus on the individual stocks, valuations, and the like. Our belief is that there's a lot more that goes into equity performance over and above simply valuation, although it is an important step in the process. To that end, so thinking about the big picture, there are 3 key things that we want to get across today or speak to today that is filtering into some of our stock picks. So we believe interest rates will come down. Many are concerned that inflation is going to be sticky, et cetera, and interest rates won't come down. Obviously, there's some ebbs and flows around the timing of interest rates coming down, but that's a core principle we've got, that interest rates will come down over time. The next big theme that we invest towards is that global decarbonization is a huge theme, and it's going to present a lot of opportunities in commodities, not necessarily just the commodities associated with these future-facing commodities that many people term them to be, but the more traditional commodities such as coal, even iron ore, etc. So we'll dig into that. And then AI, we all know about AI and how big it is. You've just got to look at the share price of Nvidia, and everyone talks about it. We don't own it, unfortunately, but we've got some other exposures across AI that we think is interesting. But I think the key takeaway here is don't let your view of AI be as narrow as perhaps looking at one stock. You need to the breadth and depth of the impact of AI will continue to broaden, and we're seeing that across many areas. So we'll dig into that very shortly, and then we'll finish up with Q&A. So we've got about 30 minutes running through stock ideas. Then we're going to dig into Q&As. I've got a bunch of questions that were sent through ahead of time, and you can ask questions on the live Q&A chat. I'm going to duck over onto the Market Matters website because that's what we are going to base the we're going to use to highlight our views. And one of those views, so the first view, interest rates will come down. A couple of ways we're playing that, Shawn. The first stock that we want to speak about is JB Hi-Fi, recent addition in our active growth portfolio. Take us through that while I get a chart of JB Hi-Fi up.
Okay, well, I'll take a step back very quickly, James, and say that interest rates have started to come down. So Canada this month was the first major G7 nation that have cut interest rates. The ECB have cut interest rates. It's already started to happen. If we look locally, sure, it doesn't feel like interest rates are going anywhere anytime soon in Australia. This is a really, really important theme. One of the factors that James and I wrote about in the last 2 days is that 9% of the ASX 200 is up over 30% this year, and 5% is down by 30% or more this year. So the polarization across the stocks in the ASX 200 is huge. And that's where you want to be on the right foot, looking forward with these global macro picks. And in this particular case, we felt interest rates are coming down. As James said, we were looking for what's our favorite pick amongst the retailers. The retail stocks, most people feel poorer in Australia. I think we all feel a bit poorer, whether you're renting, whether you're paying a mortgage, whether you're just putting petrol in the car, it's all going up. The price, whether you're in Woolworths, the price is going up everywhere. And that led to a significant sell-off in JB Hi-Fi. It fell 15%. We were stalking the trade, as we like to put it. We identified our level. It came down into our level. We put our hand up and we bought JB Hi-Fi within a few days of the low. Didn't feel great for a week or two, but bang, now look at it. The market's turned around sentiment-wise to interest rates. Has improved. Hasn't turned massively, it's just improved. But when you've got a quality stock like JB Hi-Fi, suddenly it's back very close to its all-time highs, James.
In terms of, you make a couple of good points there. So markets are pretty efficient, right? So they're pricing the now. They price what's factored into earnings, so what consensus earnings are now, and they price what's factored in from interest rates, et cetera, et cetera. So you've got to think what drives stock prices and what drives asset prices is around what comes next. So you've got to have a view on what comes next. And if there's a dislocation between your view on what comes next and what's being priced into a particular equity or commodity or whatever that is, then that can be a profitable position. So in terms of JB Hi-Fi, looking at the financials on the MM website, so you can see that FY25. The expectations are that earnings are going to be lower. So the market's pretty bearish in terms of JB Hi-Fi's earnings next year. We think that's probably going to prove to be too conservative. One of the core principles we look at from our stock-specific analysis is the expectation or the chances of earnings revision. Earnings revisions are what drives share prices. So we think the market's too negative on JB Hi-Fi. And one of the things that we like to do, and Shawn's a big proponent of this, and I've got to say that Shawn's been influenced me a lot in this space, is buying strong businesses, so strong stocks, in strong trends that pull back for a certain reason. That could be a macro reason, it could be a stock-specific reason. If you assess the reason why they've pulled back and you conclude that reason is a transient one, then you can make good gains out of stocks by buying buying those sorts of trends. So JB Hi-Fi, first cab off the rank, we like it. We've got in our active growth portfolio. It's a reasonably new addition in that portfolio. If you want to jump and see what's in our portfolios, you can see what they're doing today. You can see what they've done since our purchase. JB Hi-Fi is up here. So bought it at 56.80. We still like it today, Sean.
Oh, absolutely. I think this stock could well have a 7 handle on it before the end of the year.
It'll need a few things to go right, and it'll need to surprise on the upside in terms of their earnings. But I totally agree with that. So JB Hi-Fi is the first one. Staying on this theme around property, this is one that we wrote about yesterday afternoon. They had a good announcement. They've done an interesting deal with Singaporean sovereign wealth fund to start a new storage fund here in Australia. National Storage is the leader in self-storage here locally. It's not going to shoot the lights out, Sean. This is a slow burning stock, but it's one we really like. We've spoken about it before. We think, when we think about investments, we think about the downside. What is the downside in this relative to the upside? That's the concept of risk reward. We think the risk reward really stacks up on National Storage here, filtering in our macro views around that as well.
Absolutely. Not every single stock in a portfolio can shoot the lights out. They can't all be Nvidia. They can't all be Paladin, because you're going to have some shocking months and shocking weeks if they do as well. Those high beta stocks, they make up part of a portfolio. And likewise, National Storage makes up a nice, more steady part of a portfolio. I personally am very, very keen, I know you are as well, James, on the big macro picture here as well. There's a trend of higher density living that's going to wash through the world, wash through the Western world. Maybe not as much as Hong Kong, but if that's the case, if people are going to be moving more and more to apartments, we know that there's a huge problems in Australia with enough places to live, with the population growing exponentially, then that's going to leave people with more stuff they're going to need to store. And that is a macro trend, which I think will help National Storage. And it's a quality company whose valuation was dragged down by a recent float, or relatively recent float.
Yeah, this is the storage king that came out of Abacus. So I guess a couple of points I'd add to that. NSR so in our income portfolio, we actually held Dexus, we defended the office space for quite a while, and I think the office space is still undervalued. National Storage, though, in the last couple of months, pulled back pretty sharply in line. So the relative valuation stacked up to buy a higher quality company, not trading at the quantum of discount that Dexus was, but we think has more near-term drivers for share price. So we don't get wedded to our views. So we have firm views, but we're always testing those views. And that was an example in our income portfolio where we continued to test our view. And when something came along, because markets change every day, stock prices change every day, valuations are impacted by that, then we should be changing or at least testing our views on a daily basis as well. So National Storage, that is certainly one that we like to back the property play here on the expectation that interest rates will go down. So interest rates will go down. The next one, we've got Zillow. This is our most recent purchase in our international equities portfolio. So to find the international stocks, you can type in the code down here if you know them, or you can jump into the respective portfolios and find them that way. So the international equities portfolio is there, and then Zillow is our most recent purchase in the national equities portfolio. It's only bought less than about a week or so ago. In terms of this, as a bit of background around what they are, think of it as a REA that's over in the US. It's actually had a bit of a storied history. So there's a large hedge fund, one of the largest hedge funds in Australia, Caledonia, run by billionaire Will Vickers. They own a huge position in Zillow. They got about $2.5 billion position in Zillow. It's been a huge part of their fund for a long time, and it's really hurt the performance of their fund. Zillow's down about 70% from their highs, post-COVID highs. It's starting to move though. So if interest rates come back in the US, more property transactions will happen. A bit more activity will play out over there, and that's really important for Zillow. Sean, have you got anything to add there? I've got a few other.
No, no. I think if you're running an international portfolio, which obviously a lot of our subscribers are, there's plenty of reason to say that Zillow looks cheaper than REA now. Even though our REA is well positioned, it hasn't had the pullback that Zillow has.
No, it hasn't. REA is making or testing highs. So just to give you an idea around, so you can jump on the site, and this is true for international holdings as well. You can look at where earnings are expected to be in outer years, and you can get a detailed stock report, which I won't go into now. But you can do a lot of analysis on the Market Matters website on individual stocks, including US listed stocks. I want to hit you with a couple of stats because this was came into parts of our analysis, and I'll keep this high level. So Zillow's $11 billion market cap company over in the US. So US 11 billion, that's about 17 billion dollars Aussie. REA is a 25 billion market cap company here in Australia. To give you an idea about Zillow in 24, or the coming, so that in FY24, it's going to do a profit about 400 million US, which is about 600 Aussie. REA is at 550 million profit Aussie. REA is growing at about 15% year on year. Zillow over the next 3 years is going to grow at about 40% if consensus is correct. So in FY27, Zillow will be doing, if consensus is correct, 1.2 billion in profit, and REA will be doing about 720 million in profit. So, thinking about that, thinking the size of the market, the landscape's a little bit different, but to me, Zillow looks like a screaming buy in terms of international equities exposure. And one of the directors this week, and that's why the share price ratcheted up, one of the directors bought $100 million worth of stock. So they're backing it as well. So the stock price was up 12% on the back of that. That's we got lucky with that timing. We're not, we didn't know that was going to happen and have that influence on the share price. But it is a vote of confidence. You can see on the Market Matters website the opinions that we write, a business summary of Zillow, and you can see our actions. So we liked it below $50, then we went and bought it at $41 soon after. So Zillow's our third one. Our third play on interest rates will decline, Sean.
No, absolutely. And I think that you cannot underestimate when a board member spends that much money on a stock. It's a fantastic vote of confidence.
We think $1 million from a director is a lot, whether they're buying or selling here in Australia. They're bigger numbers over in the US. It tends to blow your mind. Okay, the next area. So the next key theme that we're going to focus on is backing global decarbonisation. So we think this is a theme that is only going to build momentum. So we all know about, the world is moving to net zero. We all know that's going to be a huge ask. We all know we're going to need to change behaviours and, the types of energy we use. But we also all know that it's a huge task, that it's going to revolve. It's going to require a lot of building and infrastructure. It's going to require a lot of raw materials to build stuff, from solar panels to wind turbines, to all of the infrastructure that plays into this global decarbonisation theme. It's something I think is going to be phenomenal. One thing that we think, and we've been bullish on this for a while, and it's not looking, it's looking soft today and in the last week, but copper, Sean, what's the take on copper? And I'm going to bring up Sandfire because Sandfire is one of our copper holdings.
No, absolutely. I mentioned this before to Market Matters subscribers. I was on Ausbiz at the start of January. They said, "What's your favorite stock for the year?" And I said Sandfire, not because I love Sandfire, but because I love copper over the coming year, 1, 2, 5 years. I think this whole decarbonisation theme is going to be very fluid. Don't forget, everyone was really on board the lithium bandwagon only a year or two ago. And then suddenly Hertz go out and sell 200,000 electric cars and buy 200,000 petrol cars because electric cars aren't yet working for them. So we've got to be very open-minded to see how it goes. But I can't see, and I know you can't either, James, from Market Matters' point of view, copper keeps coming to the top of the surface as the core underlying supply demand driven factor that should go a lot higher. There's not enough copper out there for the way everything's going. And all it really needs is China to stop spiraling backwards on its property market and I think we'll see copper move significantly higher. So to me, every dip in copper, and we're seeing just that at the moment, is a great opportunity to increase copper exposure, which we
So
did this week.
yeah, absolutely. We did. We made a move to increase our exposure to Sandfire this week. Couple of things there. So global copper demand is set to double by 2050. So that's huge. There's not enough supply coming online in that time frame to meet the projected demand. I know I don't want to hang my hat too much on projections, as Sean just said, because you go back and look at how lithium was projected to move a couple of years ago, and there was no one talking a bearish thesis around lithium, and we almost see that today in terms of copper. You think about what BHP did and what the bid they put on the table for Anglo. That was all driven by copper. It's a long-term play. So, obviously Sandfire ran up to $10, pretty frothy at that level. It's now back below $9. These pullbacks in a strong trend is what I was talking about in terms of JB Hi-Fi. Quality company. So Sandfire wasn't always a quality company, but it's become a quality company. They've delivered operationally, and they are, in 2023, I think they did about, I'm going to say about 80,000 tons of copper. And in 2026, they're going to do about 120,000 tons of copper. So that increasing production profile into higher price environment with a long-term tailwind from a demand side that's not being met by supply can only see prices higher. Obviously, commodities are cyclical, commodities are volatile, and you need to take that, that have a realistic view of the risks and the volatility in play. But that's our thesis in Sandfire, and would be, as we've done this week, we've used weakness as a buying opportunity.
No, exactly.
So Sandfire is back to our accumulation zone. So on the market today, it's down about 1.5% today, around 850. So we like it here. Keeping pointy.
One other thing very quickly, don't forget also that Harry and the emerging companies trimmed their Sandfire exposure when it popped above $10. So
Yeah,
you can
well,
play them that
yeah,
way.
we had a higher allocation in that portfolio, so we had 6% weighting in Sandfire. So we used that to trim. We had a 4% weighting in the active growth portfolio, so we didn't trim, but we've added to in weakness. So that has been our sort of. It's how we talk to active management. Active management isn't about trading, so buying one stock, selling another. It can be that, but it's often about trimming positions and adding to positions as different opportunities are thrown up. Because we know, markets are volatile, and taking advantage of that volatility is something we believe we've got an edge in. Okay, so keeping pointy, Paladin is one that we like and we're buyers of here. We bought this week or added to it this week. Uranium space, Sean.
Exactly the same thing. This was, I believe, and I know you two again, Market Matters believes that uranium is one of the energy sources the world will have to turn to get to net zero. The US is recently, or this year, Joe Biden, one of the things he's doing, apart from running an election race, is putting themselves at the US in a position that they're not dependent on Russian uranium. The whole world is looking at it. I know it's a political football in Australia, but the vast majority of the Western world is mapping out how they can utilize uranium and nuclear power moving forward. And obviously China is building numerous nuclear power plants.
And I think the big game changers, the small modular reactors that are gaining in popularity. So not only these can be built in factories and moved on the site, the actual capex is a lot less, and so on and so forth. The other thing around energy and uranium, etc., we know this is the theme around AI. So AI uses a lot of data. Data uses a lot of energy, and and we need a solution for that. So all of the large tech companies that are going down, pushing hard down the AI path, and whether it's Apple, which announced this week their sort of strategy around, or renewed strategy around AI, or it's Microsoft or Nvidia, or all of these companies, the increased demand for energy is going to be phenomenal. So on one side, we're trying to get to net zero by 2050. On the other side, there's this huge thematic that's playing out that is going to increase the demand for energy. So we need alternatives for baseload power, which uranium is. And then this is a stock that we own in the national equities portfolio. I wasn't going to put it here as one of our key picks because it's had a phenomenal run in recent times. We bought it about a year ago, but there's been a huge shift around. This is a solar manufacturing company that manufactures and supplies solar panels for commercial use. This, I think, is a company that has got a phenomenal future. So First Solar, it's up about 60 or 70% since we originally bought it, but we held it for about 12 months. It didn't do anything, and then it suddenly popped on the upside as the realization that a lot of investment needs to go into providing renewable energy sources for the increased demand and consumption of data. So that's another one I'd highlight in our international equities portfolio, Sean.
Yeah, just to put in perspective, how much energy is going to be required for AI. In the years ahead, the whole amount of energy consumed by by Japan last year will be required just to fuel the increased AI demand. It's just exponential amount of requirement.
It's phenomenal. And this is one of the core beliefs around how the global decarbonisation will impact commodities. So we think the world is underestimating how much it will take to get there. So I haven't seen a wind turbine, for instance, that is made without steel, or it's made without, and steel is not made without iron ore and or coking coal. So you think about the huge amount that needs to go into these things. We don't want to sound overly too bullish on this because they are there's going to be ebbs and flows, and Sean made a good point and highlighted lithium as one of those examples. You need to have your handle on the supply demand balance, but we think one of our core principles over the coming years is that this change will create huge amounts of opportunity in the commodity space if you keep your finger on the pulse and you know where to look, and that's what we're here to do and guide our portfolios accordingly. Another small uranium company, this is only about a $250-300 million market cap. Yeah, 318 million market cap is Peninsula. They raised money recently through Shaw and Partners. It is a highly speculative play, but it's a very leveraged play on the uranium space. And I know a lot of people like those specky ends of the market. The final theme, because we're approaching 1 o'clock and I want to get to the lots of questions that have come through, is around AI and tech generally and how that will explode and impact all areas of the market. So one thing has analysts scratching their head is CBA trading at 125 bucks a share. That's a logical conclusion given the multiple CBA is now on. What I think is that being underappreciated by backward-looking analysts is how important AI will be to driving efficiencies in all parts of, in all areas, including banking. Banking can really benefit when you've got a big top line. So when you've got a big revenue line, incremental small changes at the cost line can have a really big impact on profits. And I think that's what the market's pricing around CBA and other banks, for instance. So CBA is the leader in tech spend. Their tech stack is better than the others. So I can understand why there's being a premium, more of a premium based onto CBA. And I also understand why backward-looking analysts are still struggling to get their head around it.
Just scroll down very quickly on that page if you can, James, just to show the viewers where the fact that there's not an analyst or broker out there calling it as a buy.
No, and I don't think there's been a buy on CBA from memory since 2022. So I could be wrong on that, but you can see the consensus price target is 93 bucks. When this line, there's another, you can go in the forecasts on the website. I like this chart. So this shows that's the share price, and that's where the consensus estimate is in terms of analysts. So normally analysts are an optimistic bunch. So you see the share price well below where the consensus estimate is because they all, generally get paid to be bullish. But this is the complete opposite. So we own CBA in our income portfolio. We've got no idea to sell it at this stage, but obviously everything's got a price. But I think the explanation of why it's trading there is revolved around technology. This is a little different one. So staying on the tech space. So Catapult Group, CAT, in our emerging companies portfolio. It's had a phenomenal run in the last little while, but we still like it here. So the idea of this webinar was to discuss stocks we still like here. So it's consolidating in terms of price. So it had a really good run up on a really good announcement around getting free cash flow positive. And it's now consolidating. So around the 180, we think it's still consolidating before its next leg higher. Catapult, if you look at a dressing room, you'll see a lot of guys with black sort of sports bras with a piece in the back which records a lot of their data. So AI relies on data and how that data is disseminated and how the smarts get applied over that data. So CAT has a huge amount of data, is developing a huge amount of data. They've had a few false starts over the years, but now we think this $450 million, $477 million market cap company is right on the precipice of a stopping burning cash, and that's what they're doing, but also the market's huge for what they're doing, and the value of the data that they have we think is not being realized in the share price. So CAT is a play on data. We like it. Shawn, anything you want to add there before we go on to questions?
Just that word again, data, isn't it? Data centers is a common word at the moment.
It is. So, the data center stocks have done phenomenally well. We own Goodman in that space. It's a little bit, I think, probably a little bit. There's a huge amount of optimism that is baked into that. We still like it. We're still holding it. They're a phenomenal operator, but I'd caution, there is quite an amount of optimism built into that. So capping up. So at a high level, we've got interest rates will come down. So we like a couple of discretionary retail and property in that space. So companies exposed to that. The global decarbonisation thematic is going to push up so many opportunities in commodities. We like copper, we like uranium, but play eyes up footy. So understand it's not a set and forget approach in commodities. Commodities are never a set and forget scenario. If you set and forget your lithium positions, you're in a world of pain over the last 12 months or so. And AI is huge, but let's broaden our exposure or our understanding and our universe around how AI is going to impact broader companies, and that's what we're certainly focusing on at Market Matters. And one of the reasons why we're energy and data and all of those things are well and truly being discussed and researched here on a daily basis. So there are our three things, the stocks that we flagged in these areas. So JB Hi-Fi, National Storage REIT, Zillow over in the US, Sandfire here locally, SFR, Paladin, and Catapult, CAT, in the technology space that is underappreciated on the data front. So questions, let's crack onto them. So I'll go to Greg's first. What future facing commodities in the next 12 months should we back this year? Copper, silver, uranium, lithium. Shawn, have you got some views on that before I?
I would probably grab and say compared to where they are price wise right here, right now, I'd be looking very closely at coal.
Yep. So
I think, coal can have a good recovery from down here.
That might seem really strange to say that coal is a future-facing commodity. I guess what we're saying in terms of this, and if I liken it to, so as I said before, you can't make a wind turbine without, without making steel. You can't make steel without iron ore, and you can't make steel without coal. The issue, coal is, and this is coking coal, met coal that used in steel production, which is where Whitehaven has pushed its business towards. The supply side is not increasing a lot, yet the demand side will. Iron ore, we've been, I guess, negative on, more negative on. We're starting to get a little bit more positive iron ore. The only issue with that is that the supply response is happening. So next year, there's going to be a lot more iron ore being produced than this year. So that's our only concern with iron ore. We wrote about Fortescue this week in our portfolio positioning report. We're starting to like that as a situational dividend play. I agree with Shawn around coal. Hi guys, what's your take on Karoon and DRR? So Deterra is actually, I don't know if they're in a trading halt right now, but they're making a play on a lithium royalty stream. So they used to just be an iron ore royalty stream from BHP's one of BHP's assets, which was a really simple pass-through business, exposed the iron ore price with no OPEX or risks taken on board. Now they're going in the lithium space. Not a bad contrarian play, but it changes the risk dynamics of that stock. I haven't looked at Karoon in ages, to be honest.
Yeah,
Sean, have you got anything?
DRR's down quite a lot today, as you may know. It's actually still trading. It's down at 417. As you
Okay.
say, it's changing, does change the picture quite a lot. Lithium, we've written a few times, James, it might be looking for a low, but it also can be down here quite a long time. I'm not convinced if I was in DRR now, I'd be frustrated by that move.
So yeah, I would be too, right? So it's always been the risk. So anyone you speak to who's bullish on DRR always flag this is a potential risk. Ben Clark over at TMS, who I'm a good mate of, we've spoken a lot about DRR, and one of the concerns here that they were really keen on this stock. Not sure if they still own it, but one of the risks that they saw was around doing something like this. So yeah, I don't think that's a great move in the short term. It might be in the long term, but DRR, if lithium prices start moving and iron ore prices stabilize, etc., that's one I like the structure that they have. So they reduce the risk from an operational standpoint. Can I get an opinion on DRO and FND? So DRO drone shield. So what a phenomenal. I mean, this is just blown the shot the lights out. I don't want to pardon the pun, but yeah, it's hard to argue with that trend. But gee, it's expensive for what they're doing.
Yeah, it's one of those classic situations that if you were long, you might take a little bit off the table, but as James said, the trend is phenomenal.
Yeah, it's a billion. Like it's a so their technology is great, and what they're doing is obviously got a tailwind from the environment we're operating in now. They're a 1.1, I think, is it from memory? Yeah, $1.1 billion market cap company doing. Yeah, they'll do revenue of 100 mil next year. They might surprise on the upside in terms of how, because the trends in the way they've monetized what they're doing is actually kicked up more than the market ever expected. So this is the idea that stocks are priced off revision in earnings or underestimation by the market around what a company can do deliver in earnings. So I mean, it's run phenomenally well. I really don't. You probably stick with it, but it's a hard one.
One very quick comment there. It's not a stock I'm that close to, but it's already had two pullbacks this year of over 25%. In terms of if you like a company, a lot of them, even if they're really kicking goals, have fairly big pullbacks.
All right. So Rich is just asking if interest rates fall, Zillow should rise. Yes, that's a yep. However, if interest rates rise the US dollar is likely to fall. I think you might if interest rates fall, the US dollar is likely to fall. It depends that relative to other countries, what they're doing in terms of monetary policy. So we actually do think the US dollar will fall, the Aussie dollar will rise. If we're bullish on commodities, then you've got to be bullish on the Aussie dollar and probably more bearish on the US dollar. I like the concept of having currency exposure because it's a stabilizing factor in when you're managing a portfolio. Generally, you have multiple assets in a portfolio, so you might have Aussie equities, bonds, fixed interest, international equities, and having that some currency risk in your international equities exposure, I think, is a positive thing. So yes, on a net, on a single stocks perspective, that can be true, but I like it from a broader portfolio sense. Anything more to add there, Sean, around
No,
the
no.
currencies?
Well, I mean, I think you just got to look at it's all about the cross you're looking at. If you look at the Aussie at the moment at 66 cents, you think it's pretty weak. You look at the Aussie against the yen, it's decade highs.
Yep. It's just we got so many questions here, guys. So I'm not going to get to all of them. Just flagging it. So there's a question here just around copper and then the wire ETF. Is the ETF a good investment? And this is probably one that we get this a lot. So why buy the stocks? Why not just buy the ETF? Sandfire is a copper producer whose rate of production is increasing over time. What you get in the ETFs is a lot of diversified miners that have a part of their business, part of their operation in copper. So it's not a straight play on copper. You get a lot of other stuff in there when you go into a copper ETF. So that's why we like going into direct copper stocks. But we're certainly not against ETFs in terms of specific commodity exposure. Uranium ETFs are they're generally more more targeted in terms of their underlying exposures. Anything to add there, Sean?
No, I mean, I think obviously by definition, if the wire goes up, Samphire will hopefully go up as well. I'd rather use our know-how to pick the stock which we think will best benefit from the move we're looking for.
Yep, correct. So just a question around is PME, so Pro Medicus overvalued. So it's really hard to value on a multiple. So it's trading on a super high P, it'd be something like 100 times. I'm not sure if it's picking it up. It's on 200 times, but they are growing very strongly. There's a couple of anomalies around how pricing of that. So when a company has such strong growth, we tend to we don't own this stock, so we're speaking from not being there and probably being frustratingly out of it. When a stock like this continues to perform, we would tend to back it until they prove otherwise. So that's the way we'd play it. Yes, it looks, the question is around, does it look overvalued? Yes, it looks overvalued. But how do you play it? That's a different scenario. If they continue to deliver, then you continue to back it.
Exactly. You probably would have got out of it at the start of the year if you're worried about the valuation, and you've missed a huge move.
So this is valuations have where I don't want to. We look at valuations and we work on valuations, etc. But they've got limitations. So markets, as I said, are all around what happens next, not about what's happened in the past. And I listen to a lot of commentators who just focus on historical valuations, and they get stuck in that. So they get stuck in a stock, and each time a stock drops, it just gets cheaper. And that's, to me, that's a highly theoretical way of approaching markets, and it will lead to underperformance over long periods of time. Is what my ultimate view is around that. There's a lot more other factors that you need to take into consideration that goes into the pie around deciding whether or not a stock should be bought or not. New Hope Coal and Ordinate. New Hope, Sean.
Well,
I'll just get up.
We're long Whitehaven. We're long New Hope. New Hope's more the yield play out of the two. I think they'll both be looking good. Could it go a bit lower? Sure, it's had a bit of a tricky year. I'd call it an accumulating to weakness. I'm not sure what your thought is around your current exposure in the income portfolio, James.
Yeah, I mean, I still like it. It has been, so the main difference between New Hope, primarily in the thermal coal, exposure, so used in power generation, etc. Less, I guess, less of a bullish tilt to it in terms of, the other coal companies like Whitehaven, which has now flipped their book into more met coal, coking coal, etc. So I like New Hope. I think it goes higher with the coal price. You're going to get 8% as you sit and wait, and that's what we're doing. So still like New Hope. Ordinate. So Ordinate we own in our emerging companies portfolio, just the leader in audio visual, etc. Moving into video. They are, they've had a tough last couple of weeks, so I'll just get the chart up. So on the back of their couple of things at play, but one of the CFO, Rob Goss, resigned. The market always hates a CFO resigning, particularly one as influential as Rob, who was instrumental in the listing. He's been, he's more than a CFO. So when you're dealing with a company, normally, you can start your process at the IR function in a company like Ordinate, but Rob was that person you went to with questions, etc., and queries around how they were going. He was presenting at events, etc. So he was known and trusted and understood by the market. Him leaving is not a good thing. That's put pressure on the shares. We've written before that this is presenting a buying opportunity. We don't think there was anything more untoward around that. We spoke to the company around this, so we like it here. So we're a buy and Ordinate at these levels. All right, I'm just conscious of time. It's 1:15. I do have a hard stop at 1:15. I've got a meeting at that time, so I will wrap it up there. There are another 20 odd questions that we haven't got to, but we will endeavour to get to touch on the points that are being raised on the questions today. So one of the things that you get a real sense of is you get to test the crowd. So we get asked a lot of questions and we get a lot of subscriber feedback. So it puts us in a unique position to see what people are looking at in the market, what's they're worried about, what they're querying, etc. So we'll try and deliver content that are answering some of those questions that came through on the webinar. So thanks for joining us today, everyone on the webinar. There was a lot of people on there, so that's great. Thanks to our members for continually supporting us. And for those who are not members, there will be some offers going out end of financial year. So keep an eye out for those. Lots of good deals that's going to be sent in your inbox. So don't hesitate to reach out to one of our friendly team if you so we're Shawn, thanks for joining us.
Thanks, James. Have a great weekend, everybody.
On what's a pretty rainy week, pretty rainy Friday afternoon here in Sydney. So all the best. Have a great weekend, and we'll chat to you again next week.